So today I've got here with me my awesome mortgage broker, Phillip Ferguson. Those of you that are watching this video, chances are if you're one of our buyers, you've more than likely worked with him. But Phillip, for the people that don't know who you are, can you give a quick introduction of who you are and as well your background and where you're at?
Yeah, hi, Phillip Ferguson here, branch manager with Nexa Mortgage. I personally have been in the business for over 16 years. Nexa Mortgage, we are the largest broker in the U.S. We shop over 200 different lenders to make sure we give clients the best interest rates, best options for loan products, and fast turn times.
Awesome. Can you, because a lot of people actually aren't familiar with the difference between like a mortgage broker and like a lender, right? Because can you give an idea of like the main big difference between the two? I know it obviously, but for the audience that might be watching that's not familiar with it.
Yeah, so as a broker, again, I don't work directly for a Wells Fargo or a Bank of America, but we have the abilities to sell to different lenders. So we're kind of like the hybrid, whereas like a regular person who worked at Wells Fargo, they underwrite, they close a loan in their name, and then they keep the loan. Me, I don't work for them, but I send my package to them, and then they underwrite it up front and they close it and then they keep it afterwards. So it's kind of a hybrid, because there's some lenders who'll underwrite it, close it, and then they sell it after closing. And then you got to kind of wonder, where's my first payment going to be? Mine, I'm almost similar to the first option, but again, you already closed and owned by the lender we're selling your loan to. But because of that, we get to pass on a lot of the savings. That company doesn't pay my benefits, health insurance, anything like that. So again, we have lower margins on our loans than a regular loan officer who works directly for that company.
You somewhat answered my next question, which was going to be essentially, because there's a misconception in the real estate industry where they think that because there's a middleman involved, which is you, right, that it's going to be actually more. So can you explain that again to the people that aren't familiar of the difference? Like, how is it the savings get passed on to the clients, even though you're involved and there's one additional person?
Yep. So pretty much, as a broker, the max we can make on a loan is 2.75%, gets built into the interest rate. As a retail correspondent lender, they're having upwards to 4 to 5% margin built into their interest rates. And the reason why, because they have all these different levels of people that they have to pay. So when you think of me, yeah, there's a middleman, but think about a retail or correspondent lender. They have tons of middlemen in the middle. They've got processors that have to pay, underwriters they have to pay, sales managers, branch managers, area managers. So in essence, we actually have one middleman, me, and Nexa, whereas those other companies, they have all these other people that they have to pay, and they're on salary. Like my company, everybody is, even my processor is commissioned. So again, if that loan doesn't close, nobody gets paid. So that way we're not sharing those expenses on the next file, because we have to pay everybody a salary. They're not here. Everybody's commissioned.
Yeah, and speaking of expenses, like another expense I think we might have left out is the marketing expense, right? Because when Wells Fargo go to acquire a client, they're spending on marketing versus where a broker, you're pretty much the marketer, I guess you could say.
Yep, exactly. Doing what I'm doing with you right now is how we get our message out, and this is cost free.
Yep. Awesome. But yeah, so that's a little bit about Phillip. He's super experienced. Our team loves working with him. And if you're watching this and you had a great experience with him too, definitely comment below. But today, I want to dive right into it, because right now in the market, there is a lot of uncertainty. And it has a lot to do with, what's going on with the Fed, but also the media's hyping it up even more than it truly is. And a lot of, if you're on YouTube especially, there's a lot of clickbait stuff. And people just not giving context to the data of what they're comparing to, right? So I want to go over like what's going on with the mortgage industry and the rates, because I think the last 2 weeks the mortgage rates have been quite stubborn, right? Because it started going down, and then what happened? Can you give me an idea of that?
Yeah, it was crazy what happened. I'm going to actually bring up a chart right here. Okay, 1 second. All right, so you can kind of see here, this is July 4th time frame. You can see the market went from all the way to 98.6 basis points all the way down here to 96.38. So almost a 200 basis points drop we had in the previous last 2 weeks. Now, once everybody was kind of giving some predictions about the core inflation report, you can kind of see we made up almost all of our losses. Yesterday, we did have some loss, but again, even if you measure here, we're still back on track to where we were back on June 12th. So as you can see, the overall trend currently right now is we are going to get better. The last inflation report only came in, alone rose 0.2%, and they were expecting 0.3%. So it was lower than anticipated, which is why we had these gains here, and then significant gains. We're anticipating by the end of the year, industry average, we should be around 6%, but you can bet your bottom dollar Nexa mortgage will be lower than that 6%.
What is a basis point? Like what are the candlesticks that we're looking at?
So again, green is meaning interest rates are getting better.
Okay.
Red is pricing. So I shouldn't say interest rates getting better. It's the cost of interest rate, because you can always get
they're borrowing money essentially, right? To lend. Yeah.
Right, because you can always get, a 4 or 5% interest rate. It's just how much does it cost to get that interest rate? So on a daily basis, that rate the cost of that rate changes. So again, it just depends. But I mean, again, if you were to buy a rate here today at 4%, it would cost you 200 basis points less than buying it down here. And it doesn't traditionally translate 100 basis points is 1%. You could buy 4% at no charge, but getting 3.99 or 3.875 might cost you 100 basis points or 1% or 200 basis points. So it just depends on the margin that lender puts it on. So again, in theory, if you could buy this rate directly from Fannie Mae or Freddie Mac or Ginnie Mae, the government entities that buy these, yes, you could get it right at 96.3, and you'd only have to pay 400 basis points or 4% to get a 5% interest rate.
Got it.
But every lender has their own margin that they put on top of it. And again, it doesn't say 100 basis points equals 1%. I mean, it could a quarter of a point could cost 100 basis points. So it all depends. But I mean, again, all I try to show clients is, hey, with this chart, you can at least see where rates are trending and how much is going to cost you more potentially. So this is just like a ballpark idea.
Got it. Okay. You mentioned CPI report, right? So from my understanding, at least what I've been paying attention to, the inflation was getting better. No?
Yes. Inflation is getting better. I mean, we're almost to the same price we were at March of 2021. It
was like in 3-4s now, right?
Say what?
It's in like the 3-4% now.
We're right. We were like 3.99 is where we came in, so which is awesome. But again, it's still what they're doing with the inflation to kind of control it is they do the Fed rate hikes. So because it didn't go down, that's why they're going to continue to do some Fed rate hikes. So but again, it only went up 0.2%. So, I mean, hopefully, maybe next month it only goes up 0.1%, and the following month it doesn't go up at all. And then once we start to see inflation going down, that's when the Fed will stop doing their Fed rate hikes.
Yeah. So some of the stuff is a little tricky to me too, because the way I look at it, like it's like a never-ending cycle almost. Like, I feel like at a certain point, it's like, can we just be patient and just wait it out, like for the like Fed aspect, because they're like on a whole nother extreme level. It feels like almost like they're just like, all right, we're gonna do another rate hike. We're gonna do another rate hike. And it's like, and at least in real estate and everything in life, it's like it takes like months for this to like actually correlate. And I just feel like it's like an upswing, downswing, upswing, downswing. That's like a continuous effect almost.
And it's funny that you mentioned it, because I was watching a video maybe a week or 2 weeks ago, and the issue that they're having is that the Fed has to react as it happens, versus some of our economists that are really smart guys. They're looking at what should have happened prior to needing to do these rate hikes. Like, one, we should have stopped issuing all this stimulus money a long time ago. Yeah. That caused it. And increasing minimum wage. So, I mean, you have all these different factors that should have been taken into consideration, and we should have started Fed rate hikes a while ago before they first started, and we wouldn't be in the situation right now. So that's the thing, is just the Fed is trying to catch up to what's already happened. So now they're trying to correct it, but there is light at the end of the tunnel, though. I think we're almost there where we're going to stop seeing any Fed rate hikes for a while, and then again we're going to start seeing interest rates get better.
Yeah, I'm hoping for the same. I want to refinance a property or two next year, beginning of next year. So apparently they're going to do 2 more rate hikes, right? And then from my understanding, like those 2 shouldn't affect the real estate market too much because of the recent one that they did, which already had the effects apparently. And we were just chatting about this before. And theoretically, when Feds do their rate hike, it's not supposed to affect the market, right? But why is it that it's affecting the market? Can you give an explanation on that? Because to me, that's very confusing. And I'm sure the same thing for the audience.
Yeah. So again, mortgage-backed securities are similar to bonds and stocks and bonds, and they almost work opposite of each other. So again, what happens is because the Fed rate is usually only affects short-term notes. So credit cards, auto loans, equity lines of credits, those are the only things that are truly affected by the Fed rate hikes. They're completely different from mortgages. But like stocks and bonds, if you hear some speculation of, oh, something's going to continue to happen, or hey, we heard, this company laid off a lot of people. So now you've got people reading into things and then either pulling their money out because of emotions. And one of my mentors back in the day says, when emotions go up, intelligence goes down. And so again, it's just people's emotions that's pulling money out. But again, I can't blame them because again, they're trying to anticipate what the market's going to do so they can be ahead of it. So because we've got people that are trying to forecast, and then we've got the Fed that's reacting right now. So the people that are trying to forecast, they're the ones who's kind of really pushing where the market's going right now because they're deciding whether they're going to pull their money or invest their money. So again, it's kind of cyclical, and this is going to continue to happen. This happens all the time. I mean, again, at one point in the mortgage industry, rates were like 8 and 10%. So this is not new territory we're in. I mean, again, that's what the Fed had to do before. They increased the rates, and then we finally got them back down. So it's a cyclical market that we're in right now. Again, this is not our first time, but things will get better.
Yeah, hopefully, man. So I was looking at today's rate. I don't know how accurate this is, but I'm using what's on Google and some other resources. Is it true that today, right now, 30-year fixed conventional is 7.55?
Yeah, 7.55, and again, that's an industry average. So again, if you were to take an average of every lender, yes, you're around 7.5%. Again, I can tell you Nexa, we're definitely lower than that. Again, depending on credit score. And I tell everybody, there's so many different things. I tell everybody, an interest rate is almost like a fingerprint. Because again, it depends on how much money you put down, what your debt to income looks like, your credit scores, the type of property you're buying.
That come into factor.
Exactly.
Yeah, and it's because a lot of people will see that and then they just assume theirs is going to be at that point too. But after majority of the time, it's going to be completely different from the average. It could be higher or less depending on your fingerprint, as you mentioned.
Yep, exactly. We'll make sure we put them into the right loan program because there's other programs that have lower interest rates than that.
Yeah. And so that with that, then essentially that would mean our VAs that would be probably in the average is 6.5 right now, right?
Yep.
Yeah. Okay. So yeah, VA loan, things like that. What do you think is going to happen for the rest of the year in regards to the mortgage rates?
Again, as I stated earlier, we're anticipating on average with the last 3 inflation reports we've seen are trending in the way that we're expecting. And again, I don't think the next 2 Fed rate hikes are going to have much of an impact this go around. I think we're going to start to see interest rates go lower, and hopefully by year end on an industry average, potentially around 6%. So I'm excited.
Yeah, it's definitely interesting. Being in the industry for a while too, I've seen the pros and cons of all market. I'm sure you've seen a lot more. And for me, because a lot of people are scared of the rates being where it's at. But I always tell my clients that we're working with, this is kind of like your buy-in to not be in a bidding war with 20 other people. and getting paying 50,000 plus over asking, right?
Yep.
That's just your buy-in, and because regardless, the move's gonna, like, people that's got to move, they're gonna move regardless whatever the rate is, right? Like even me, for example, I bought back in last November. I think I got in like five and a quarter or 5.5, whatever. It was that period when rates were starting to go up. Got a beautiful home. I only was in a bidding war with one other person. So it was phenomenal because I was able to get closing costs and as well structure the deal in a way where it was a win-win for everybody. So that's like the one neat thing about the current market.
Yeah, and what I would add to that is, again, as we're going to start to see interest rates get lower, and as the word gets out, you're going to have more buyers try to enter back into the market, which is going to create that frenzy that I've been talking about.
Yeah.
Again, we are going to be bidding against other people. So it's better right now to get in the market, buy the house now, because again, values of houses are still increasing because again, we still have a housing shortage. So it's better to buy the house now versus it going up $20,000 in a year. And then if rates do continue to get better, you could refinance it and closing costs probably maybe be $7,000. So it's better to buy it now, $20,000 cheaper, and only spend $7,000 later to get the interest rate lower.
Yeah, there's so many pros and cons of both markets. And to go to what you're talking about, I'm going to share my screen real quick. This is our local market data, so the audience can kind of see what's going on. But even with the rates increasing, right? Like our median sales price was at an all-time high at 345,000, right? So just imagine what's going to happen. I think once we go under 5, it's going to be mayhem.
Oh yeah,
it's going to be mayhem because there's a lot of pent-up demand. And there's just certain people that are holding back right now because they might be in a 3%, 3.5%. But then once you get underneath that 5, it's like, oh, it's only 1 point difference. Is it like at that point, it's like, it's probably gonna be worth it to make the move, right?
definitely.
And I mean, if you look at the data, like, because everyone keeps talking about the crash. There's a transaction count crash, right? But not a price crash. We haven't seen that, and that's what the media keeps talking about, is the crash, and then all the YouTubers talking about that. But in majority of the markets, and nationwide data is quite similar actually. But our active listings in Hampton Roads alone, in June we had 3,366, 3,217 in May. So, and it's down 18.1% year over year from June 2022. And the one thing that I always bring up too to my clients is like, 2020 to 2022 was almost like an anomaly. And you can't really compare that much in reference to the anomalies either. I just try to show the context because, like, we've never seen rates. I remember someone locking in at like 1.75 VA loan. It's, just crazy stuff. And like, you can't compare anomaly to like, if you compare this to 2019, prior to 2019, it's actually quite similar. We're at like similar levels now, and with higher rates. So I think it's going to be mayhem once it goes underneath 5. But if you look at it, pending sales, right, same thing. This is where the transaction counts are currently down 19.7% year over year is down, but the median sales price is going up. And there's people sitting on the sidelines that's thinking like everything's going to crash, but there's just no data to really support that. Even our monthly supply of inventory in June is 1.47. I remember back in 2019, I'm over here in the northern Suffolk area. I mean, there were homes sitting on the market for like 4, 5, 6 months before it went on the like beautiful homes. So it's it's just a matter of time, quite honestly. But we're nowhere close to it. When your median days on market is 11 days, there's no crash that's happening, unfortunately, for prices. Like, it's still super competitive.
Yeah, and once rates do get 5%, you're gonna have brokers like me that are gonna be advertising the crap out of their 3-2-1 buy downs. So that means once it hits 5%, for the first year, your interest rate is gonna be 3% lower. You are gonna have that 2% interest rate you've been wanting.
Yeah.
And again, so you're going to be at 2% the first year, 3% the second year, 4% that third year, and then back to 5%. But again, hopefully within that time frame, rates continue to correct themselves. But again, I mean, the temporary rate buy downs, I mean, that's going to be huge pushing for many loan officers everywhere, because everybody wants a 2% interest rate. And we can give that to you temporarily. And again, hopefully within that time frame, rates continue to correct themselves, and then we can permanently refinance them to a lower rate.
Yep. And, like to go off of, like how the market's still going strong, that doesn't mean you can't get a good deal out there, right? Because like there's the reality is the inventory is low. So that's what's causing it to still be somewhat competitive, right? But I'm out there buying properties still as an investor, and as well, like I'm still buying properties. Like I just closed on one that's a fixer upper, right? And it's just, I'm still doing it. So it's not like that. You can always find deals in markets. And especially as a homeowner, you just have to be realistic with what you're looking for. Like now is definitely a great time to be able to get into homes where you can, where you're not getting into a bunch of bidding wars, and you might be competing with 2 or 3. But if you find the right property, like the one I just found, like I wasn't really competing with anybody, and just got a great deal. I'm looking for off market or either past 30 days on market, right? And you're able to get good deals. But anyways, Phillip, is there anything else you want to cover, man?
No, I mean, I'm just excited to see what the market is going to do. But I mean, again, like you said, there's always a deal to be had. And I highly urge everyone to buy now before prices go up. Even worst case scenario, if you were to have to buy a house over asking price right now, the way values are going to still increase, you're going to recoup that, and then plus still be able to refinance later. And I can actually we can do another report later. But again, the cost of buying a house over asking price, and does it still make sense? Again, because the way values are increasing, it still makes sense, and you're not going to have to compete with much people. Again, depends on what areas you're buying into. I just had a client recently looking to buy in the Hickory Grassfield area. I'm like, you better be ready, buddy.
Exactly. That's what, like, as long as you have the right mindset and the right location, you should be good. But for those that are watching, whether they're agents or homeowners or buyers, where can they reach out to you at?
Yeah, you guys can reach me cell phone 757-582-5974, or you can reach me at homeloan757.com.
Awesome. Well, appreciate your time today, Phillip.
No problem. Take care.